Today's discussion delves into a fascinating paper examining the world of exchange-traded funds, or ETFs. It tackles a significant issue: the surprisingly high levels of short interest and failures to deliver in the ETF market.
Indeed. The sheer volume of short selling in ETFs, disproportionate to their market capitalization, has raised serious concerns.
Concerns that range from naked short selling to something entirely different.
Exactly. The paper introduces a novel concept to explain this phenomenon:
And that concept is?
operational shorting.
Let's start with the basics. What exactly is operational shorting?
Operational shorting arises from the unique creation and redemption mechanism of ETFs. Authorized participants, or APs, essentially market makers for ETFs, can sell ETF shares before they've actually purchased the underlying assets.
So they're selling something they don't yet possess? That sounds risky.
It is, but it's not necessarily malicious. They have a short period, typically up to T6, to acquire the underlying assets and deliver them. This delay is often driven by operational factors.
Okay.
For instance, creation units are typically large blocks of shares. If demand is less than a well unit, an AP might wait to accumulate enough demand before purchasing the underlying assets. Or if the underlying assets are less liquid, they might wait to minimize price impact.
How does operational shorting differ from naked short selling, which is illegal?
The intent is key. Naked short selling is intentionally selling without the ability to deliver, aiming to profit from a price drop. Operational shorting is a liquidity provision strategy, a temporary short position with the intention of covering it within the allowed time frame.
So failures to deliver FTDs can result from both?
Precisely. The paper uses FTDs as a signal, but it argues that a significant portion of ETF FTDs are due to operational shorting, not necessarily illegal activity.
How did researchers measure this operational shorting?
They developed a clever methodology. They compared the buy-sell imbalance of an ETF, a proxy for investor demand, to the change in shares outstanding, reflecting actual creation activity. A positive buy-sell imbalance without a corresponding increase in shares outstanding indicates operational shorting.
So a mismatch between demand and supply fulfillment.
Exactly. They normalized this mismatch by the number of shares outstanding to create their operational shorting measure.
And what do they find regarding the relationship between operational shorting and FTDs?
A strong positive correlation. Their analysis showed that higher operational shorting is associated with a greater number of FTDs. This held true even after controlling for other factors like short interest and borrowing costs.
Does operational shorting predict future ETF returns? The literature often links short selling to future underperformance.
Interestingly, they found no such relationship with operational shorting. This supports the idea that it's primarily a liquidity provision strategy, not informed short selling aimed at profiting from price declines.
The paper also explores the impact of operational shorting on the underlying securities held by the EPF and on systemic risk.
Yes. They found that operational shorting can actually improve the liquidity of the underlying stocks. By delaying the purchase of the underlying assets, APs prevent immediate pressure on those markets. It acts as a buffer.
But the increased FTDs are still a concern, right? Especially regarding systemic risk.
Absolutely. The paper highlights the interconnectedness of APs, a liquidity crunch at one AP leading to increased FTDs and operational shorting in one ETF could potentially spread to other ETFs the AP trades, creating a ripple effect and increasing systemic risk. They also found that higher leverage among APs amplifies this risk.
So the interconnectedness of APs and their leverage levels are crucial factors in understanding the systemic risk implications.
Precisely. The study found evidence of contagion effects. Operational shorting in one ETF by an AP was linked to operational shorting in other ETFs traded by the same AP. Higher AP leverage further exacerbated this effect.
What are the regulatory implications of these findings?
The research highlights the need for a nuanced approach to regulating short selling in the ETF market. Simply focusing on FTDs as a proxy for illegal activity might be misleading. Regulators need to understand the distinction between operational and naked short selling.
Are there any areas for future research?
Absolutely. The paper primarily focuses on operational shorting in the context of excess buying pressure. Investigating the behavior of APs during periods of excess selling pressure, what they call operational buying, would be valuable. Understanding the symmetry or asymmetry in these strategies is crucial.
Let's summarize the key findings. The paper introduces the concept of operational shorting, a liquidity provision strategy by APs that can lead to FTDs.
Correct. They developed a novel measure to quantify operational shorting and found a strong positive correlation with FTDs, but no predictive power for future ETF returns.
Operational shorting can improve underlying stock liquidity, but also contributes to systemic risk through contagion effects among interconnected APs, especially when APs are highly leveraged. What are the practical implications for investors and market participants?
Investors should be aware that a portion of ETF FTDs might stem from operational shorting, a legitimate market-making activity. However, the interconnectedness of APs and their leverage levels pose systemic risks.
This discussion has shed light on the complexities of ETF short selling and the crucial role of operational shorting. It's a nuanced area with significant implications for market stability.
Indeed. The research highlights the need for a more sophisticated understanding of market mechanics and the potential for seemingly benign activities to contribute to systemic risk.
Thank you for this insightful discussion.